And today it's my pleasure to welcome Barry Ward to kick off our East Ohio Women in Agriculture series. And Barry is our resident expert when it comes to taxes here for Ohio State University Extension. He's the director of our OSU Extension, our OSU Income Tax School, and the leader of production business management here within Extension. So we are very pleased that Barry is here with us today. And Barry, I'll turn it over to you.
Thanks a lot, Emily. It's my pleasure to be with you today. It's a topic that maybe is not the easiest sell and not the easiest for us to manage and work through. Income taxes. It's hard to find excitement in that, right? But we're going to do our best and hit some of the issues that might be meaningful, might be financially helpful to you as you navigate your way through the world of taxes, right? And this is going to focus on income taxes. However, if you have questions on other tax issues, property tax issues, sales tax issues, if you have those questions and you'd like to go down that path for a little bit, I'm happy to try to answer those questions as best I can. I was struggling with trying to find a starting point for this particular session. It's always difficult because there's always folks with different levels of interest and knowledge as far as how we work with income taxes. So I'd like to start, and I don't have a polling question on this, but if you'd be interested in starting to put some things in the chat feature, the chat window, let me know if you would, whether or not you hire a tax professional to do your taxes or you self-prepare. So I'm just curious as far as kind of the makeup of the group. If you're willing to share in the chat, that would be interesting to know whether or not you hire a tax practitioner, CPA, an enrolled agent, any number of tax professionals out there. There are different kinds. So we'll see if anybody's paying attention. But okay, I'm going to go ahead self-prepare. Okay, well, we've got one. Thanks, Emily. Thanks for starting us off. And yes, you have a household that would self-prepare, I'm sure. So very good. All right. But I think I'm going to start, and I teach a class on campus on farm management. I'm going to start with a few slides that typically start with on this particular subject, having to do with tax, managing income tax. So we're going to start here. And then we'll get into some more advanced topics, and we'll even talk a little bit about the new legislation that was passed right around Christmas and how that may impact some of your tax preparation, tax credits, also how it may affect your income. So we'll talk about some of those more advanced subjects towards the end of this presentation. But let's start out with some kind of the basics, I guess. And this is a little bit dated, but talking about taxes leads us to the idea and the thought of where do these taxes go towards? What are these taxes used for? And we're going to focus primarily on federal income tax issues, although we'll dip a little bit into the state of Ohio, talk a bit about that. But it's a pretty big pie, right? As far as all the federal income tax dollars that are spent each year. This just gives you an idea. General idea, and again, this is a little dated as far as how the pie is divided up and what it's spent on when we do collect, when the federal government collects our taxes. Okay, the other thing that is joked about often, and that is, okay, we continue to pass legislation. Just how big is the tax code that governs federal income taxes? Someone has done the count over the years. This is a little dated, now 6 years old, but as far as the number of pages, if they were to print them out in regulation type, whatever that might be, the tax code continues to grow. And if we were to think a little bit about the new legislation that just passed in December, which is called the Consolidated Appropriations Act 2021, that was several thousand pages in itself. So that gets, at least a portion of that legislation gets added to the federal tax code. So no reason, there's very good reason that we have tax professionals, tax practitioners that help us navigate income taxes, because the tax code just continues to get more complex. Okay, we're going to try to look into the black box, if you will, if you don't mind that cliche, and talk a little bit about some of the issues that you don't necessarily need to know all the mechanics surrounding all of these different pieces of the tax code, but more importantly, how to strategize as farm business owners, how to really come up with the best ways of planning to maximize long-term after-tax income. And that's the thing that I try to stress to the students in class and to every tax group or every group that I present to on this particular issue of taxation. There's essentially three different kinds of tax that we deal with at the federal and the state level as far as income taxes. There's ordinary income tax, there's capital gains tax, and there is self-employment tax. Okay, so those that are engaged in a farm business, you're likely going to have to deal with all three of these over the course of the business life. Ordinary income tax, that's the typical kind. Schedule F income, if you're not familiar with what a Schedule F is and you're just getting started perhaps in your farm business, that's the form that we're going to fill out if we have a farm business. Schedule F. It's pretty easy to remember. F for farming, right? So it's one of those that should be simple and straightforward. Capital gains tax, if we have assets that we've held for a certain amount of time, we typically pay less of a tax rate, okay? And that's oftentimes the case with many of the assets that we hold for longer than 1 year. And oftentimes, in most cases, we don't have to pay self-employment tax on that capital gains income. We do have to pay it on most ordinary income tax. So that's something that farmers deal with. How much is it? Does anybody out there in the audience know what that is off the top of their head? Self-employment tax rate. It's one of those things that's burnt in my brain, unfortunately, over the years and dealing with taxes. But self-employment tax, which all business owners have to pay, not just farmers, but it's a percentage, and part of it goes to one thing and part goes to another thing. There's two parts that self-employment tax essentially covers. One is Social Security and the other is Medicare. So these two pieces, 15.3%. It's kind of jarring when you think about it, but it goes towards those two types of retirement long-term care types of benefits, if you will. Okay, let me go to the next slide. So how do we calculate ordinary income tax? We look at our net farm profit. We look at other taxable income. We subtract personal deductions, subtract 1/2 of self-employment tax, and then we can throw in there now, we can subtract qualified business income deduction. That's new, all right? Tax code got more complex and in some ways got a little simpler under the Tax Cuts and Jobs Act that was passed in 2017. It's been a long time ago now. And that gives us our taxable income and ordinary income tax that we have to pay. Capital gains tax, I mentioned this earlier, income from the sale of certain assets called capital gains, reported separately, taxed at a lower rate. So we need to make sure that we are doing this. And if you're using tax software, and who isn't these days? You know, everyone now has tax software that we can use. It makes our life much easier. It doesn't absolve us, though, of doing proper planning. And that's one of the things that hopefully I'll continue to point out and we'll get across over the course of the next 45 minutes is the planning and the strategy. That's something that the tax software doesn't handle for us in most cases. And I am, one that I've been around long enough that I have actually prepared my income taxes by hand. So this is going back, 30 30 years now, I guess. But the first income tax returns that I did by hand. Didn't have any personal tax software that I could use. Now we have TurboTax, all kinds of different tax software that we can use, and it makes our life a lot easier. Tax professionals have very complex software that handles tax preparation, even the complicated taxes that most of those professionals end up doing makes their life easier as well. So all of these different issues, including separating taxable income between ordinary income tax, capital gains tax, software will handle that pretty easily. Okay, self-employment tax, which I've already mentioned, it's essentially directed at two different programs, Social Security and Medicare. Self-employed individuals, as I mentioned, pay 15.3%. So they pay the full amount. Okay, if you have an employee, you're only paying half of that. Okay, the employee pays half, the employer pays half. So what we term as part of the payroll tax, that's what we're talking about. So an employee pays only half, a self-employed person pays the full amount. Okay, so now I think I'm going to switch gears and talk a little bit more about some current issues, but I wanted to set the stage with just talking about some of those issues that were more basic in nature. And I know you've gotten some of that over the programs that you've covered in the past. Many of you have been engaged in women in ag programs and other programs as well that may have given you some of the basics of tax issues. And if you have questions, please throw those up in the chat. Curious to know what kind of questions that you might have relating to taxes. And again, it doesn't have to just be income tax, but okay, we're going to talk a little bit about more current issues. And I've already mentioned this, the ordinary income tax, capital gains, and self-employment tax. This next slide is just meant to soften you up a little bit because of the issue. These are my new twin grandsons. So they dressed them up in these onesies the night of the OSU football game. It didn't give them a lot of luck, however. So we're trying to forget about the football game and that happened this past Monday. But anyway, they're a real pleasure most of the time. They're, just like babies. They can, they've given their parents, a lot of sleepless nights in the last couple of months, as babies do. But for a grandpa, they're a real pleasure. Okay, so that's just meant to brighten things up before we talk about the heavy issue of taxes. Let's not make it too heavy though. Okay, so strategy and planning. One of the things that farmers deal with, and you all, I would expect or have dealt with, are the ups and downs of income. And farm income is notoriously up and down from one year to the next. This is just showing you the USDA prospects or the outlook for farm income in 2020, their expectation for what it's going to end up with. And then also we go back the last 20 years. So we go back to 2000 and we're looking at net farm income and net cash farm income, slightly different measures that are calculated. Basically, one is just a cash look, one is an accrual-based income look, and that's the net farm income here below this kind of blue-green line. The key point that I want to show you, and it's pretty evident, right? We've got lots of ups and downs, and this is the U.S. All together. This is all U.S. farms lumped together, and we know that sometimes that even smooths out some of the variations. So variations of individual farms are likely going to be at least this bad as far as the ups and downs. So what do we have? That gives us, if we don't have specific tools to manage taxation, income tax, we could have years where we would have extremely high tax bills and then perhaps a loss down here. What we've done over the years is that we've been given certain tools through legislation that will allow us as farm business managers to manage these highs and lows. And thank goodness, right? I mean, it allows us to smooth out our income, especially if we're preparing taxes and we're claiming our business on a cash basis. Okay, our business income, we're a cash basis taxpayer, and that's going to be, if not all of you on this call, it's going to be the large majority. You can choose either to be a cash basis taxpayer or an accrual based taxpayer. If you've never filled out the back page of Schedule F, then you're a cash based taxpayer. And that's going to be the most of you on here, as I mentioned. So we can manage these ups and downs, and there are certain tools, and some of these you employ every year. Some of them perhaps you use some years. It depends a little bit on, again, the ups and downs that you're dealing with. So if we have significant ups in income, so a significant year, large amount of income, what can we do to help at least mitigate some of that income tax that we might be dealing with if we have that real high income year? Well, farmers, farm business owners, what do? Well, you buy equipment, you buy stuff. And the tools that we have now is we can write that off, expense that in the year that we purchased it. So accelerated expensing, this is a really big tool, and this is for all businesses. All businesses have this tool that we can help manage the highs and lows, and in this case, the highs of income. We can also prepay business supplies. This is more specific to farm businesses. So if we were coming down to the end of the calendar year, and most of us are calendar year taxpayers as well, where we're using January 1st through December 31st. You can also choose a fiscal year, and you may have a tax year that you declared to the IRS starting in, for instance, October and going to the end of September. But most of us just use a calendar year. It's simple, it's more straightforward. We don't have to deal with some of the issues that fiscal year taxpayers would have to deal with. So you're a cash basis taxpayer, you're a calendar year taxpayer, and towards the end of December, you start to work out and you do your estimated income, and then of course your estimated taxes. As you work through some of this in your mind and perhaps on paper or a spreadsheet, you start to determine that I'm going to have a pretty high income and I'm going to have a lot of income tax to pay. So what do? You start to figure out ways that you can buy equipment or prepay expenses. Now, most of us are going to do this strictly to manage income taxes. Well, that's something that the IRS wouldn't want to hear. Okay, we have to, at least when it comes down to an audit, perhaps, we have to have business reasons to prepay expenses that ultimately will allow us to manage our income taxes. We have to have business reasons, and most can come up with a couple. Oftentimes we prepay expenses to find discounts or just to make sure that those supplies will be in our inventory and we're not going to miss out on buying fertilizer or seed. We can't spend more than 50% of our total supplies for a given year. So we can't, buy too much. And it also has to be prepay supplies for specific supplies. It can't go into some general fund that's not specific to, a certain amount of fertilizer or a certain amount of seed. Okay, so it has to be for very specific types of purchases. That's one thing that if you were to get audited and you've been prepaying business supplies to manage taxes and other business reasons, you have to have that laid out into specific supplies. It can't go into some general fund. If you were to get audited, the IRS would not like that. They would probably disallow those expenses. So it's just a point of reference. One of the reasons I point that out is that we've had, at least here recently, we've had some people that have asked their businesses were trying to sell them on this idea of putting money in as a deposit into their business for basically the idea of prepaying supplies. And it had no specific direct application to specific supplies. It was just going into a general fund. This is not a proper way to prepay business supplies. And we can also, manage the downs. Farm businesses on the, we look at this first one, income averaging. This is specific to farms and allows us to put a certain amount of our taxable income in a, if we have we can put a certain amount of the income in the previous 3 years. It's Schedule J. And actually, I should have put this up into the managing the ups, and I'm going to have to change this slide. But the income averaging is Schedule J, and it's only available for farmers and fishermen. Okay, so we can take, if we had 3 prior years of down years, and we had this year, 2020, this past year, of a very high income level, we can take a portion of that net income and move it into the 3 previous years. So it's a good tool to use if you have, again, these ups and downs. Net operating losses, farmers have a little bit more flexibility. If we have a down year, we can take that loss on the Schedule F and we can move it into a year where we might have had a profit. We then can take advantage of those tax savings retroactively in some cases. Or we can move that net operating loss into future years. So farmers have a lot of tools to help manage these ups and downs. Okay. Feel free to throw a question up in chat if you have those. And we're going to just keep on chugging. All right. Current issues. And some of you have had to deal with some of these things and had to deal with non-typical income here in the past year or two. Ohio has had significant prevented planning indemnity payments over the last couple of years, more so in 2019 than 2020, right? And that income can be deferred into the subsequent year to the next year if you so choose. If you have a history of greater than 50% crop sales, that you typically defer. So there are some issues there, but prevented planning, that's one part of insurance indemnity payments that we can defer or can move to the next year if it's going to really result in a real high income in this particular year or that tax year. Okay, here's one that everybody's been asking about, these government program payments that were paid last year, these Cfap payments, if you will. Cfap 1 and 2, those were direct deposited in most cases into farm business owners' accounts. They have to be claimed in the year that they're received. There's no way that we can have flexibility on those. They're going to show up on your 1099-G that you're going to receive. That 1099-G then is going to be something that's shared with the IRS. There's no real flexibility here. NRCS cost share payments claimed in the year received. Farm Bill program payments, whether they're the typical ARC PLC that arrives in October, or these WHIP payments that some of you received in 2020 and may have received in 2019, they have to be claimed in the year that they're received as well. Revenue insurance payments. All right. If you have crop insurance, a large majority of you have revenue insurance products, and then subsequent to that, you have indemnity payments if you have a loss. Okay, revenue insurance payments are paying us for one of two things, a yield loss or a market loss or price decline. Technically speaking, according to past legislation and also case law that shows up in courts, the portion that's due to low prices, if you have that, a portion of an indemnity payment from a crop insurance claim, that should be claimed in the year that you receive it. If you have a portion of that revenue insurance indemnity payment that is due to lower yields, however, you can make the argument that you can defer that part of that indemnity payment. All right, so this is still, and you'll find that as we go through and you start to get, if you do decide to get more immersed into tax issues, there's often a lot of gray area, unfortunately. In some tax cases, there's a gray area, and this is where CPAs and tax practitioners will have difference of opinion. Some will file your taxes based on their own aggressive approach. Some will file taxes on a more conservative approach. It's those aggressive tax filers that end up eventually going to tax court by the IRS. Not all. I don't want to scare you from being aggressive in your tax stance, but it's some of those aggressive stances that end up being challenged by the IRS. They go to court, and that then sets us up for having new bright lines, if you will. The IRS often gives us somewhat ambiguous guidelines when it comes to preparing our taxes. So, it's not a perfect world. There's a lot of this gray area that exists in tax law and as we go to prepare taxes. All right, and this is one of them, this revenue insurance payment. We feel, and when I say we're a part of the Land Grant University Tax Education Foundation. Acronyms are horrible enough, right? But the Land Grant University Tax Education Foundation is a group of universities, land grant universities, of which Ohio State is one. And we put together educational materials for tax practitioners each year. Okay, and this is a stance that this group has taken, that this indemnity payment from revenue insurance products, we could technically, theoretically split these indemnity payments. Part has to be claimed in the year that it's received. Part, the portion due to low yields, you can either claim it in the year that it's received or you can defer it into the next year. All right, the Farmer's Tax Guide, actually Pub 225, if you want to jot that down, I'm sure everyone does. You can find that online. You can find that at your local extension office, hard copy. I've got about 8 boxes of these that I have in the back of my truck that I'm hauling around Ohio when I get the chance and dropping them off at different extension offices. But it's an important document or an important publication when it comes to dealing with your tax issues. It's online. Yes, thanks, Emily. She just put up the link for the PDF. It's something that, it's free. It's really a good publication if you have questions and you want to go do some research on something tax related when it comes to the farm business. The Farmer's Tax Guide, Pub 225, you've probably seen it. It has the stance that revenue insurance payment indemnity payments, those have to be claimed all in the year that they're received. We disagree with that position. And again, it's gray area. It's a gray area. It's maybe not a big deal, but it may be a big deal for some of you that have those indemnity payments in a certain year. And it's in a year where you have a high income and you just as soon push a little bit of that income into the next year. All right, last but not least, there's been a lot of these Syngenta settlement payments occurring. Some of you got checks this year. Those have to be claimed also in the year that they're received. So this is a year that I think it's going to be different depending on whether or not you are a crop producer or a livestock producer. We started out this year in the early months of 2020 with more of a bleak outlook for both crop and livestock producers. Crop producers received a significant amount of these ad hoc program payments, along with perhaps Syngenta settlement payments. So the income levels might have been a little bit higher than you were expecting, might have to deal with some of these issues, and you had to already do and handle some of those by prepaying expenses or buying more equipment perhaps. Livestock producers, certain dairy producers, it may have been a struggle, and you may be on the other end of the spectrum where you're have a net operating loss perhaps that you would then use to offset a good year in the past or upcoming, hopefully good year, right? Okay, I'm going to exhale for a little bit here. And if there are any questions, well, I'm not seeing any show up. So I'll just continue on. Okay, something that came up from the Tax Cuts and Jobs Act. This was passed, it seems like yesterday, but it was actually back in 2017, right before Christmas. This was significant change in the tax code, one of the more significant changes that we've had in the last 30 or 40 years. Most of it was beneficial to us as far as lower tax rates, the addition of what we call this qualified business income deduction. It's been beneficial, lowered our taxes, but it also threw a little bit of a curve at us, and this getting rid of the ability to like-kind exchange equipment. We still have the ability to what we call 1031 like-kind exchange real property, including land. That's typically what we think about and what you hear in the farm press, and you may even talk about with your colleagues that you can 1031 like-kind exchange farmland. You can sell your farmland that's right up against Columbus, perhaps, that you can sell it for $100,000 an acre, and you can go out and buy a larger farm out in a more rural area and get a much bigger chunk of farmland. And basically that exchange, most of it, if it's a similar amount, is tax-free. So you're pushing that taxability of that income to a later point in effect. We don't have that ability anymore with machinery and equipment. We used to have that with equipment, just like we did with land, this ability to take advantage of these like-kind exchange rules. We no longer have that. We now have a taxable event when we trade in farm equipment. Now, for most of us, it's not a big deal in federal income taxes because we have this ability to immediately offset any of that gain that we have from the tractor or combine that we trade in by using these accelerated expensing tools that we have. We can take Section 179 expensing, or we can use bonus depreciation to immediately offset that gain. Okay, so let's look at an example here. Tax planning for exchanges, gain though not ordinary, it's not self-employment income. So we do have some benefits to this as well. This last point that's down here at the bottom, this sometimes gets brought up as far as looking and trying to plan for what tools that we might use to depreciate or expense our purchases. So if we buy a piece of equipment and we might want to write it off completely in the year of purchase, we have this code section, Internal Revenue Code Section 179, that allows us now, right now, the rules are $1 million that a business can use per year to offset income. Or we can use bonus depreciation. Presently, it's 100%. So this is, these are tools that we can use to accelerate our depreciation or offset, write it off in the year that we buy it. Then we have the regular depreciation rules that allows us to meter it out over a number of years. Equipment, new farm equipment, we can expense that over 5 years. We don't have the time to really get into how the depreciation rules work in this particular session, but if you want more, I'm happy to provide the details. So again, it's a new mix of income for farmers. Most farmers trade in a lot of equipment each year. All right, well, or at least one piece perhaps. You may have some years where you're trading in a couple of pieces of equipment. Some years there may be zero, but oftentimes there is a trade-in of something each year. It's going to be, and it's going to show up as low or no ordinary farm income, where you're going to have a Schedule F income is going to be lower than what it used to be pre-Tax Cuts and Jobs Act. And you're going to have some of this, what we call depreciation or capture. It's going to show up as income on Form 4797. And it's got some good and some bad. The good is that you may not have self-employment tax due. The bad is that you may not have self-employment tax due, and it may affect eventually your Social Security and Medicare benefits. So we have to approach this with a little care as far as how this may impact our farm income and tax. State of Ohio tax issues. The thing is, with these bonus and accelerated depreciation methods that we have, good tools to have for federal income taxes, the state of Ohio doesn't retain the same rules. So they, what we call, decouple from the federal tax code when it comes to Ohio income taxes. Just when you thought taxes couldn't be more confusing, well, we throw another wrinkle, not we, but the state of Ohio, and it's pretty similar in other states too. They don't allow you to accelerate, write off these expenses in the year of purchase, not as quickly as the federal tax law will allow you to do. So this gives us another wrinkle. Bonus depreciation, Section 179 expensing, they have limitations on Ohio state taxes. So with this new tax law and the way farmers do typically trade in more equipment than most businesses, it allows us, or it's going to give us some headaches. The one thing that we do have, though, in the state of Ohio that helps most businesses out is this Ohio business tax exclusion of $250,000. So if we have income, business income up to that amount, it's tax-free. Anything above that, it's at 3%, so it's a lower rate. So businesses have a really big break in the state of Ohio, and it's going to really capture most of the business income, and you're not going to have much, for most businesses, much income tax to pay for the state of Ohio. But I want to go through an example here. This is what kinds of headaches that we have to deal with if we're trading in a lot of equipment in a given year and you're trading in a lot of high-priced equipment perhaps. This is actual numbers from a commercial grower, a commercial farmer that I know, and he's traded in a sprayer and 2 planters. So this trade-in value, this is what the equipment dealer was willing to give him over here on the right, upper right-hand side for these 3 pieces of equipment. At the same time, he was trading them in, right? So he was buying this kind of middle column here, the new purchase list price of these 2 planters and a sprayer. All right, so he was essentially buying equipment worth about a little over $1 million, and the trade-in value of the 3 pieces was about $750,000 in green here. Okay, so the new tax laws require us to capture and claim this gain, this $723,500. Tax Cuts and Jobs Act got rid of like-kind exchange for equipment trade-ins. So what do we have to deal with? We have to deal with this gain right here. In the past, we essentially only had to deal with the difference in these 2, and we could expense that amount in the year of purchase if we so choose, if we chose. Got to get my tenses right. Okay, so how do we deal with that? Well, we have all kinds of tools that we can use. Section 179 expensing allows us to write off up to $1 million in the year of purchase of business assets. And so we can offset that entire amount of gain, so we're not going to have to pay tax on that. We can write it off. The problem is that this $723,500 does not show up on Schedule F. It shows up on Form 4797. This amount that we're going to write off does show up on Schedule F. So it's going to offset ordinary income, self-employment income. And so that's the rub. That's where we're starting to see some issues show up. Tax basis remaining then, we still are going to have this amount. We can write that amount off too if we so choose, up to $1 million. But to offset the gain, we only have to use a part of the Section 179 expensing. So our taxable income, at the federal level is 0. At the state level, and I can provide these slides if you want to really spend some time later on in going through these, or I can spend more time explaining this. But we have much more complexity when it comes to the state level. Doesn't allow us to write off that full amount. And so we have essentially some income, some taxable income at the state level. Potential Ohio tax due, you can just see that, and I'm not going to spend time because we don't have a lot of time to finish up here today, but it does give us some additional things to think about at the state level, especially if we have a larger commercial operation that we're trading in multiple pieces of equipment at a time, and we're going to be over that Ohio business tax exclusion of $250,000. So larger farms are going to have to deal with some headaches. So what I went, I'll come back to what we had talked about earlier. One of the things that this is also going to cause is concern for future benefits. If farm business owners are going to be planning to rely on Social Security and Medicare, and most do, as at least a part of the retirement benefits, we're going to have to make sure that we are paying into both of these funds. And to do that, we have to pay self-employment tax. You have to have so many quarters accrued in both Social Security and Medicare to be eligible for the full benefits of both of these. So just be aware and make sure that also that if you're starting to do some planning, and this is another step into the complexity of tax law, is that you understand what we call Social Security bend points. Your eventual Social Security benefit is based on how much you actually pay into and pay in terms of Social Security. So your self-employment earnings are important in determining your final formula of what you get paid in Social Security. So if we look at this year, okay, Social Security bend points, and I'm going to have to go back and, sorry. All right, yeah. I had to go and look at my cheat sheet, my little notes. If you pay in the average indexed monthly earnings, so if you're earning about $960 a month, all right, presently in 2020, and that's your self-employment earnings, that's your average indexed monthly earnings, and you're paying self-employment tax on approximately that amount, you're going to get about 90% back. So the return on your investment is pretty high if you have this average indexed monthly earnings of this amount, self-employment income, Schedule F income, if you will, on a monthly basis. So multiply that times 12. That's a pretty good return on your investment if you're claiming that much self-employment tax, self-employment earnings, I'm sorry. Between bend point 1 and 2, it starts to go much lower, 32% between that as far as your return on that investment. And above that second bend point, then the return on your investment as far as what you pay in versus what you get out of Social Security, well, it starts to decline even further. So this is a whole nother subject, but I wanted to bring it up just to scare you a little bit and make sure that you don't zero out your self-employment income each year, especially younger people with this new tax law. It's going to be a little easier to do to not pay any self-employment tax. And if you're going to rely eventually on Social Security and Medicare, and I know people talk about, oh, it's not going to be there when I, retire. It was said 20 years ago, and it's going to still be there next year. So anyway, bend points. If you want to do more homework, this is a good place to start on this consideration of self-employment tax. Okay, make sure that you're paying some in, enough to get the quarters necessary to have a Social Security benefit and a Medicare benefit when you do retire. All right, one of the big new pieces of the Tax Cuts and Jobs Act is C Corps had a much lower flat tax rate. Most of you don't have C Corps, okay? But the reason I bring this up with the new tax law in 2017 is that it also added this other piece to the puzzle, this qualified business income deduction, which if you have, most of you that have small businesses, farm businesses, even if you're not real well versed in this, you've been using it, okay? Your tax software automatically calculated it for you, or your tax practitioner is using it. Most of you probably have heard of this. It's been now 3 years that we've dealt with this qualified business income deduction. It's 20%. It's pretty straightforward. And most of your income, your Schedule F income, C income, rental income on Schedule E, is included in your qualified business income to take this deduction at 20% for most of you. It's pretty significant. The reason they included this in the Tax Cuts and Jobs Act, if they hadn't, and they had included this, this decrease in C Corp tax rate, well, then it would have been a no-brainer to change your business over to a C corporation. With this qualified business income, it essentially levels the playing field, similar to what we had pre-Tax Cuts and Jobs Act, okay? So those of you that have sole proprietorships or partnerships or LLCs that are filing taxes as a partnership, you essentially have a lower tax rate, similar to what the C Corp would have. Okay. I'm not going to spend much time here. However, the qualified business income deduction does give you a benefit for some of you if you're selling to a cooperative versus an independent. There are different rules for sales to one versus the other. The thing that I'll point out here below, and I can't even click on anything, can I? Sorry, folks. This last point, farm businesses with no W-2 employees may have a larger qualified business income deduction by selling to cooperatives. All right, there's a lot of reasons why. Well, there's one particular reason, is that if sales to cooperatives, the calculation for a qualified business income deduction has a certain amount of backing out of the deduction if you have a W-2 employee. So if you have a farm business, you don't have employees, you need to consider this particular issue, that if you're selling to cooperatives, you may have a benefit as far as your net qualified business income deduction. If you want to talk to me more about that, you can email me or give me a call, and I can go through some of the reasons. Here's the new forms, as if we needed new forms, right? But this is the new form for claiming a qualified business income deduction. You may not have even realized you were filing it. The software is going to fill this out and include it with your tax return. But this is a new form with a qualified business income deduction. It's one of the biggest new pieces in the last few years as far as what you're dealing with on your farm tax returns. Some strategy, what are we doing as far as strategizing and with the new tax law? Deferring year-end sales, properly managed prepays, which I've already brought up, smart machinery and equipment purchases. Sometimes we get sucked in to managing tax in a particular year and not really thinking about the long-term scenario. Do we need that equipment? Sometimes tax management kind of rules our decision-making when it shouldn't. And making sure that we have enough cash, we may have had a good year in 2020, and we're wanting to offset some of that tax bill and not really thinking about what's going to happen in 2021 and 2022 if we don't have these large ad hoc government program payments. Might it be smarter to pay a little bit higher tax and have a little bit more cash in store for the next couple of years in case things do change and we may not have the markets that we have now, we may not have the ad hoc government program payments in the next couple of years, and we're going to need more cash reserves. It's always a balancing act. Entity choice, we don't see anything really floating to the top with the new tax law as far as one being a little bit more beneficial than others. That's a whole nother class as well, but we can talk about that in a future class. May want to plan for some income to take advantage of qualified business income deduction. I've already mentioned the issue of planning to pay some self-employment tax to take, making sure that we have the appropriate amount of payments in to be able to claim and be able to take advantage of Social Security and Medicare when we retire. A number of other things here that I'm not going to have time to mention. There's a lot of resources. I just want to mention the Consolidated Appropriations Act that was passed before Christmas and signed after Christmas. There's a lot of things in this new tax law. This is a follow-up to the CARES Act that was passed as a result and directly related to COVID-related issues in our economy. That was passed this past year. This is some additional follow-up legislation. It's given us a lot of things to think about and a lot of things to do in terms of planning for farmers. The big pieces of the CARES Act and this new legislation, these Cfap payments, Coronavirus Food Assistance Program payments. Now we're looking at Cfap 3.0. And there are significant outlays to different farm sectors. Crop farmers are going to get $20 an acre for certain crops, flat rate for, I think, planted acres. This is not my wheelhouse, so I don't spend a lot of time in the specific ag programs. There's going to be a lot of assistance for livestock producers as well. Cfap 3.0, those payments are going to be coming out later this winter after they get all the guidelines and rules set. The thing where I've been spending a lot of time is this Paycheck Protection Program payments and these other kinds of tax-related issues. There's also a lot of tax credits that were available from the CARES Act in this subsequent legislation, this Consolidated Appropriations Act. It was a giant piece of legislation. It not only extended the ability of the government to continue operating, but it also provided more in terms of relief, COVID-19 related relief. So the Consolidated Appropriations Act, it was a significant piece of legislation. Stimulus payments, those are coming your way. We had $1,200 per individual after the CARES Act. This new legislation lays out another $600 per person, $1,200 per joint filer or for joint filers, and then also additional $600 credits for qualifying children. So there are phase outs. Those stimulus payments should be starting to be distributed here in the next few weeks if you haven't already received yours. This Paycheck Protection Program, and this is where I'll end, this has been significant for farm businesses. And it's now available, and they changed the guidelines and the rules that were governing the Paycheck Protection Program. So if you weren't able to receive one in 2020, that doesn't mean you can't receive one now. They changed the rules for farm businesses, and you can base your application and the subsequent forgiveness of this loan based on gross income now. So if you didn't have the $100,000 in net farm income in 2020, under the previous rules to qualify for what amounts to $20,000 plus in a forgivable loan that doesn't have to be claimed on your taxes. And you can then also take the expenses that you use that loan to pay for, and you can write them off on your Schedule F. So we had a lot of benefit coming with this new Consolidated Appropriations Act. So if you want to take advantage of that, you have to get with your lender or your accountant in some cases that will help hook you up with the lender that's providing these loans. It's a limited amount of money, so getting in early is beneficial. And if you've already had one of these loans, you can sign up for a second draw. They have PPP second draws now available. You have to have had a certain amount of a decrease in gross receipts, however, in 2020 compared to 2019 to get these second draw PPP loans. But for the large majority of you, if you haven't taken advantage of these, this is a way to help boost your income and help you manage through some of this crisis. Okay, so that's the real recent stuff that's tax related. There's a lot of tax credits. You can look at our farm office page. There's a lot of articles there. Also, you can look at we have our recorded Farm Office Live versions that go into more detail on some of these current issues of what's happening that are tax related. So, okay, I'm at my hour, and I guess I will just put forward, there's a lot of slides here and I'll share these, but I wanted to, well, there's so much that you can capture from our additional information on our Farm Office Live recordings. Here's my contact information. I know Emily already put up my email address. Feel free to reach out to me if you have specific tax questions or just follow-up questions from this session. I'm happy to talk to you, or we can email back and forth. I also wanted to go back up here to some of these additional resources that I can't seem to find. But there are a number of things that are available out there. Well, it's poor organization, isn't it? That you would think that I'd be better than this. Here they are. Okay, here we are. And Emily already put up the link to the Farmer's Tax Guide. There's also this rural tax education site that has really good explanations on a variety of issues related to farm tax issues. Our farm office site, that's listed, Ag Lease 101, Ohio Ag Manager. There's some other affiliated sites that we work to develop that have a lot of additional information on tax related subjects or farm management related subjects. So, okay, I'm going to stop sharing, and that's more than probably what you wanted on tax issues. But well, you're here, so you knew that it was going to be tax related. I'll answer any questions that I can.
If you would like to ask a question now, you are welcome to unmute yourself instead of typing it in, because sometimes it just takes too long to type it. So if you'd like to ask anything, feel free to unmute yourself.
Information overload, or more than what perhaps you wanted. So I'm used to this on at the end of tax presentations. Sometimes it takes a while to gin up a question after seeing.
And sometimes you may just be a processor, and you may just need to chew on this for a while, and you'll come up with some questions later. We appreciate that Barry shared his contact information with us. So please do check out the resources that are there in chat. Farm Office is an amazing spot to go. If you have not used that yet as a resource, there's just so much information that's there, legal kinds of information, tax information, other business management resources. So be sure to tab that, or star that in your search engine. And if you have any questions at all, be sure to reach out to Barry.
Just invite everyone to attend our Farm Office Live sessions. We're going to go into a lot more detail on some of these issues, and I know that some of the folks that are on there probably will be in front of you too at some point this winter, so you may get them twice as far as their information. But I know I go into a lot more detail on some of the new issues that are tax related on our Farm Office Live as it relates to this new legislation. So if you want more, you can visit us. You can be on with us tomorrow morning. We have another Farm Office Live session tomorrow morning, and I have registration information if you need it. So thanks. I want to thank Emily and Kate and all of you for being good students. Thanks for being with me.
Thank you so much, Barry. And thank you all for being a part of this first webinar in our series. And if any of the other topics look interesting to you, we hope to see you back on another Thursday over the noon hour. And we hope that you have a great day.